Hey traders, Stephen Coitzel here with TradersPlan.com. We have a lot to cover today. We're going to look at the overall markets, trying to find support, but we'll see if it can get going. We're going to cover a game plan for how to trade market corrections and how to slowly get out and slowly get back in and trade less while it's whipsawing around. So real quick, got to make the lawyers happy, so I'm going to show you this disclosure. Okay, let's get going. Okay, so let's start with the S&P 500. You can see that, actually before I get going on that, sometimes I do upload these videos to YouTube the evening before I email them out. So you can just search the Traders Plan on YouTube and I'll be the first one. If you want to subscribe there, you would get to my videos a little bit quicker immediately as they come out. So starting with the S&P 500, you can see it's really trying to hold this long-term moving average. So far it's holding. We have a double bottom right here. So we have the second leg down. Personally, I would have preferred to see this leg undercut this leg, so just for a nice shakeout, but it doesn't always happen that way. Now you had a nice reversal day right here at the long-term moving averages. You didn't really have that this time. You did have a reversal, and we're going to look at the hourly chart here in a minute. But yesterday you did have an outside day on the S&P 500, so now it's trying to kind of rip a little bit higher and bounce off this. There's only really one time where the S&P 500 closed below the 200-day moving average, but you can see when this leg started off, you kind of had a little bit of a gap coming out of there, and then it ran for a few days, and now we got a little bit of a gap. So we're going to see where the real test is. What you want to see, though, is you want to see a market breakout. You want to see a follow-through day. And, you know, I've been following IBD, Investor Business Daily, for a long time, and how they identify a follow-through day is it has to be four days from the bottom. So 1, 2, 3, 4. A minimum of 4 days from the bottom, and volume has to be above the prior day. So it's an accumulation day, a minimum of 4 days off the bottom. You had one right here. It went up to here, and then it just struggled to come back down. So not all follow-through days go on a nice little rip like this, but that's what we're looking for right now. I think that the outside day we had yesterday was kind of not really the equivalent to a reversal, but it's, you know, not all bottom points do you get that bullish reversal. So, you know, it's showing that it's trying to go the other way. But again, we're just going to keep our eye on it, and when these uptrends resume, they can move very, very quickly. So when an uptrend resumes, like let's look at this breakout day, probably this is a follow-through day right here, or maybe it's right here. You're going to want to look and see how the S&P 500 holds the 20-day moving averages, because they can come out of these market corrections and ride the 20-day moving average from anywhere from 4 to 7%. And if you're owning individual stocks, they can be up a lot more than that. So you want to try to get in as early as possible. But understand, we still are in a market correction. We are not in a confirmed uptrend. The 20-day moving average is curling down, but it's starting to try to curl a little bit. So, and there's a lot of distribution down here. Look at all these red days in above average volume, and you really don't see any accumulation days in above average volume. So understand, we're still in a market correction. There's more distribution than accumulation, but it only takes one breakout follow-through day, one reversal, and then a follow-through day, and that gives your odds of success much, much higher. And we're going to look at that in greater detail here in a minute, but let's start with the hourly chart on the S&P 500. You can see that this reversal right here, it came all the way, this is the February sell-off, it came all the way down to 25.32, but the closing support was at 25.60. And you can see over here, earlier this week, I believe that was on Monday, there was closing support at 25.60. So this level is really, really important in the S&P 500. And it held, so that's a positive on the short term. Now we're making a series of higher highs, at least on the hourly chart, so we're going to see if it can climb its way out of here. I do think this 2,700 level is kind of an important test because if you go back, there were several times where it was support, 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 and then broke through and then turned into resistance. So you have this gap right here. You know, don't be surprised if it goes up into this gap around 2700, 2710, pulls back a little bit. But again, once we get that follow through day, once we get that breakout, then we're really trying to focus on, can the S&P 500 hold that 20-day moving average? So if we, let's go to the Nasdaq, because I want to sit here for a minute. I know this chart is a little busy. Actually, what I want to do, let me move this volume off below price. Kind of get that out of here. Come on. Okay. So I have lots of markups, but you have the candles that are the price, right? And I want to talk about a game plan for how to let the market get you out, right? Run out all your stops, and then how to slowly get back in. So we're going to sit, this is a chart of the Nasdaq. We're going to sit here for a second and walk through this and just how volatile this is, these market corrections are, because Lord knows they are not perfect, but we're going to walk through it. So you have a nice, here, let me annotate this a little bit. Let me kind of move this. So this is the Nasdaq, the daily chart. You have a nice little uptrend, right? And then what you're looking for at the end of an uptrend is you're looking for a character change. Character change doesn't mean we're going to go into a bear market. It just means some distribution is starting to come in. So you have some you have a nice smooth uptrend, and then you have some choppiness, okay? Then you have that first gap. So when you get rattled a little bit, when you're in an uptrend and then the market rattles you a little bit, you get your first gap, or you get a reversal, kind of like this, but you can see the market just charge higher. That's a moment when you want to raise your stop. So when you get that first gap or that first reversal here, and I'll even put it right here, you want to put in place and raise your stops. So you can see that if you would have gotten this reversal right here, you raise your stops, you wouldn't have been stopped out and the market headed higher. And then you get this other gap. So you have your stops in place from the previous reversals, and your stops are in place. You raise them to protect your trades, and then you start to get stopped out. Okay? So I believe, if I remember correctly, I was stopped out on this gap. I started to get stopped out on a couple trades up here because there was some tugging and pulling. And pretty much by this day, I was in 100% cash because I just bought something. Actually, I got stopped out here, and then a gap stopped me out, and I was out. So this whole waterfall, I was in cash, okay? So, and I'm not telling you to go 100% to cash. It just stopped me out. But let's just say you raise your stops, and you're getting stopped out, and then you have maybe one trade that's hanging in there. So let's just say you're 20% invested during this waterfall, 80% cash. Okay, so then you have just a really nice reversal right here. Okay, so a nice rule of thumb, and again, these are just rules of thumbs. You can tailor them to yourself, but you want to raise your stops in the gaps, right? And then if you start to get stopped out, you have to get back in because, the market's not going to go down forever. So then you get a reversal right here at the long-term moving average. A good rule of thumb is to take a small position. Like, for example, if you have a $10,000 account, you're taking 4 to 5 positions, let's just say 20% of your account, right? You're not really invested. That way, if you take a small position on the reversal day or the day after, and if you get stopped out, it's not a big deal because it's a small place in your portfolio, okay? So then, let me move this out a little bit. Then you have a follow-through day right here. So then you add another position. Let's say now you're 40% invested, okay? Because you got in on a reversal day, a small amount. That way if it got you stopped out, it's not a big deal. And then you get in another 20% on the follow-through day, okay? So then you have a nice little flag here and then a breakout. Now you're getting in more, okay? So let's say now you're 60% invested. Well, then you have this happen. So probably what happened here, I bet anything, this trade right here just got stopped out. However, so now you're back to 40% invested. You still have these two trades. And then you have your reversal. So you can put back another trade on, right? And then ride that up. Then, so now you're 60% invested. Then you have that nice reversal, right? That first character change, so you're raising your stops, okay? So on this position that you own, this position you own, and this position you own, you're in the money on all of them. And then you get this reversal. Now you're raising your stops because you were stopped out on this one, okay? So you just got 3 out of 4. So now you're starting to get triggered out. So maybe you made a little bit of money on this one to break even. But you're probably pretty good in the money on these two because you raised your stops all the way up here to protect your capital. So then you have another waterfall, right? And your stops are just getting run out, okay? So I don't know if that runs out all your stops. Maybe you still have, maybe you booked gains on this one and on this one, but you still own this one. So now you come all the way down here, you're back to 20% invested again. Then you have another reversal. So you slowly get back in and now you're 40% invested. So I know this is a lot to take in, but again, if you can learn any from this, when you're in an uptrend and you get the character change, right? You get the character change in the market, the reversals or the gaps, then you raise your stops, right? And if you start to get stops and you start to get stopped out where there's break-even gain or a loss, let it run until you get a reversal in the market and a follow-through day, right? Put money to work on the reversal in the market and put money to work on the follow-through day. And as you reach little points in the uptrend, then you can continue to slowly let it get you back in, right? So in market corrections, there are whipsaws. It's going to happen. This trade right here, you get stopped out. But the market long-term has an upward bias. So you have to understand that you can't have, oh, it's the big one, it's going to be a bear market every time we have a market correction, okay? So you get stopped out right here. Now you're probably 40% invested again. Let's say you still own this one, or maybe you don't. Maybe this waterfall took it out. And now you're back to 20% invested. So now you get this outside day, which is a reversal. It's not as good as a reversal of this one. I like this nice long wick. I mean, this just ran out all the stops and came back. But it is a reversal at a long-term moving average. So, you know, you put money to work this day or you put money to work on the next day, okay? And then you wait for another follow-through day to slowly let it get you back in. And remember, if you have a follow-through day, and I've studied these follow-through days, you really want to and you can ride that trend, but when the Nasdaq or the S&P 500 start to break the 20-day moving average, start to change characters, you need to make sure you have your stops in place. So I hope this was helpful, and I hope this was just a way of looking at things to keep it simple. And that's what you always want to do. You want to keep trades simple. And to add to that, when the market is in a correction, okay, and you can identify it as a correction by, you know, the market's down 10% or more, or the 20-day EMA is in a pretty good decline, or the VIX is above 20, probably a combination of them, okay? So when the market is in a correction, a way to protect your account from all these whipsaws, because it's going to happen. There is no way to trade long-term without whipsaws. You're going to get in these sideways actions where you're just not going to get a lot of bite, a lot of upward trend. You take half positions, you take smaller positions, so that way when the whipsaw happens, it's not a matter of if, it's a matter of when. You know, you're getting stopped out to amount that really doesn't bother you that much. So basically, if you're earning, let's just say 70% a win ratio in an uptrend, right? But then you're in a correction, so your odds of winning are declining, right? Let's just say down to 50%, and that's if you're trading right. But those 50% trades, those should be smaller trades, because again, your main goal is to protect your capital during a correction and not to get chopped up and spit out and lose all this money you made on this previous uptrend. trade less, trade smaller until you get a nice uptrend again. So I hope that was helpful. That's just, some rules that I abide by, and I know it's busy, but again, slowly get in, slowly get out. Look for those character changes because we all have personalities. Stocks in the market has personalities too. You have to know when a personality change is happening, because 3 out of 4 of your stocks, my stocks, are going to move with the overall market. Simple as that. Okay, so with this being said, you can see this. So we took a double dip down, right? This took a double bottom, okay? So I want to compare this double bottom to the 2015 correction just to show you how these reversals, how you can play these follow-through days, and you'll see them time and time again. Where is that 2015 correction? Okay, so look, you have the 2015 correction in the S&P 500. You didn't really have a reversal anywhere, right? So it was 2 days off the bottom, got slammed back down, right? So you really weren't investing in this leg, okay? So maybe you have a breakout day on this day and then it rolls back over, okay? So stop out number 1. Let's just call this stop out number 1. Then it takes a little mini double bottom. Then you get a reversal in the market. You're back in. Let's just say 10 to 20%. Then you get a follow through day. You're in some more. Say another 10 to 20%. So you could be anywhere from 20 to 40% invested at this time. Then you have a nice move. And as it's holding the 20-day, you can continue to take more trades and let it bring you back in. So now it's pulling back to the 20-day moving average. Now, this character change, this isn't that obvious. There is really no reversal. There's no shakeout, but I feel pretty confident if I throw some volume on here. Let me just throw it above real quick. That's not what I wanted to see. Volume. Color volume. Let's do that. Okay. So right here, you can start to see the distribution accumulate on this leg down. So it's a warning sign, but at the very latest, you're out. You have this 20-day EMA. So, this is probably a pretty good distribution day right here. So again, it's changing characters. It's already tested the moving day out, the 20-day twice right here. Typically, third time is not a charm. It's typically a break. And then you have a character change. So now you understand your stops need to be raised, and maybe some of them are in and maybe some of them are out. But again, then you get that reversal. But on this reversal, it's in below average volume, so you have to be cautious. Then it just rolls right over, okay? So then you have this little mini double bottom. No real good reversals, but look at right here. Actually, probably this one is the follow-through day. Then you have a follow-through day on this day. I don't know why I keep doing that, but let's track this. So you have a follow-through day right here. Actually, this is the follow-through day. You can see the volume is an above average, and it comes back, and it's still kind of shaky. You can see it tries to sell off. Finds support at that 20-day moving average by the end of the day, and then you get a nice uptrend out of there. So again, they're not always cut and dry. That's just not, the market's not going to make it that easy for you. But you're looking for the reversal, you're looking for the follow-through day, and hopefully after that reversal and follow-through day, you can ride the 20-day moving average for a nice uptrend and raise your stops after it bounces a couple times or after it changes characters, okay? So this happens again and again in history in the market. So you just, because this is all human behavior, right? This isn't anything special. This is just human behavior, fear and greed at its finest when these reversals and these breakouts, these trend changes have to happen, and you see over and over what happens. But again, in waterfalls, you almost always have to expect a shakeout. Right, and because there is not many V-shaped recoveries that come straight out of it. You're going to waterfall, you're going to pop back up, you're going to get shaken out, and then you got a nice little uptrend. You're going to get a nice little uptrend, might get chopped up a little bit, goes back down, shake out, goes back down, and then you get an uptrend. So that's why a lot of times this double bottom, and if we go back to the current market situation, let's go back, you have a double bottom. You have a double bottom right here. But to be fair, it's not a clean double bottom. This is ugly. But market corrections are ugly. Okay, so just keep that in mind. You always just want to protect your capital when the market is this volatile, because it can chop you up and spit you out. So if you learn anything, just make your trade sizes small until you get that clear uptrend. Okay, let's look at the dollar. Let's kind of switch gears for a second. Let's look at the dollar. Let's scroll down here. So you have the USD, the dollar. This is the weekly chart. So it's in a downtrend, right? That's a bear market all day. So you have could potentially be a mini breakout very soon, and then if it breaks out above this, I really do think it's going to break out above this. Now, this dollar could be a counter trend rally, okay? It could just be a nice counter trend rally, but that counter trend rally can turn into a new uptrend. So one just needs to keep that in mind. And you can see right here at the bottom, the dollar is negatively correlated with gold, because you can see down here it's almost at -1 and has been for pretty much ever. There are times where they are correlated, but for the most part, the dollar and commodities, being gold, are negatively correlated. So that means that the dollar does break out, gold could stay suppressed. So just keep that in mind. Now, when the dollar does break out, that's typically better for small caps. Small cap leadership typically follows the dollar. So, you know, if we get a nice uptrend and then the dollar's headed up, small caps are probably going to outperform. Whereas they have underperformed for quite some time, really since 2016. Small caps have underperformed the S&P 500. That's because the dollar has been in a downtrend. So then you have also the S&P 500. If the dollar is weak, it's typically better for international stocks. So when the dollar goes down, typically the relative ratio of the S&P versus the international stocks goes down. So then you had a breakout, and it might have been a false breakout, but I believe if the dollar does break out, this is going to come back. In S&P 500, the U.S. stocks are going to take the leading stage over the world stocks. So all eyes on the dollar. In my opinion, it always is. I think the dollar moves everything else. Everything else does not move the dollar. Okay, so let's look at commodities. So commodities are under some pressure, even though some commodity stocks are doing well today. So you have the U.S. dollar is on a eight-year trend line. Is on an 8-year trend line, so you can see it kind of broke it a little bit, but it's a zone. It's not exact. It's a zone. So we're, you know, it's just interesting to lay these charts on top of each other when you have the commodities go down, the dollar goes up, and then you have the dollars goes down. Commodities are trying to come up, trying to break through this head and shoulders, but you can see it did break out and is getting pushed back down. So, you know, I'm going to keep going back to, I think that if the dollar is going to go up, I mean, these commodities could get rolled over, which typically means that could roll over some of the emerging markets and some of the international stocks. I don't mean completely roll over. I just mean underperform relative to some of the other sectors out there. Let's look at the TNX, the 10-year Treasury yield. Where is it? Okay, so this is the TNX, the 10-year Treasury yield. It's been in a bear market since 1981. You know, and then you have this really inverse head and shoulders since 2011. Nice surge off the bottom since 2016. Bull flag breakout. It's getting right at this 3 level, and it's trying to pull back the last couple weeks. You know, don't be surprised if it doesn't break straight through. It could pull back a little bit just to create another flag before it punches through. So, I mean, look at this chart. It goes all the way back to 1974. So you have a nice 44-year chart right there. These topping or bottoming patterns, if we just look at this, right? Actually, let me index this. So if we can just look at this, oh, that's weekly chart, so that's not going to give me the exact. So 300 weeks, this topping structure was. So that was about 6 years. So it took yields, 6 years to break this head and shoulders. If I'm doing my math, maybe 5.5, before it created a new secular bear market. Now, right now, we're in, well, longer than 6 years, but this just goes to show you, it takes a long time for these ships to turn around. But I do believe it is going to turn around because we're, getting into more of an inflationary environment. We'll just have to pay attention because anything could change. But you can see down here that yields are positively correlated with financials. So if yields, the long-term trend is up, should be positive for financials, should be negatively correlated with utilities. So you can see down here, other interest rate sensitive, which utilities are in a bear market. But that really takes me to the chart I want to look at when I look at financials. I got too many charts. Oh, there it is. Okay. So you can see right here the S&P 500 down here, but this is a relative ratio chart. This is the relative ratio of the XLF. You can see that the XLF outperformed the S&P 500 till late 2006. We all know what happened there. And it's really performed in line with the S&P 500 really since the market bottomed in 2009. And then you have this breakout. Now this is a weekly chart, so this takes a while to develop. So then you have this breakout, right? It could be very significant as far as which would correlate with the yields going into a long-term secular bull market. That should help financials outperform the S&P 500. We'll have to wait and see what yields do. But that adds to the evidence that yields and financials are correlated and could outperform, or at least financials could outperform the S&P 500. By how much, I don't know. I don't have a crystal ball. But, if you're always looking for that edge, and again, this is a very, very long-term chart, something to consider. Now, you can see right here, this is XLE versus the S&P 500. So the XLE outperformed the S&P 500 since 2008, where commodities peaked significantly. All commodities pretty much peaked at the same time. Tried to come back 2011 and just rolled over. But it's interesting, the energy has underperformed the S&P 500 since 2008. And then you got this downtrend right here. Now, this is a relative chart. I think energy is trying to make a comeback. This again could take a while. You can see it tried to break out and then got hit back down when the market pulled back this year. It's trying to come back, but you could have energy significantly outperform for a while. It's on the cusp of a breakout, so just keep that in mind. I think the future is bright, but I could be wrong. But I'm watching this for a definitive breakout of the XLE. So let's go back and look at some market breadth. So really, I like, when it comes to breadth indicators, I try to keep it as simple as possible. I look for, is the majority of the stocks, is the bigger trend up? And yes, it is. We are in a correction, but we still are in a bull market. I really just look at the percentage of stocks above, in the S&P 500 above the 200-day moving average. This 60% line is a nice little place to look. You can see it is really on the cusp of moving back above. It's in correction mode right now. It's close to moving back above it. Now, this isn't something that I make trading decisions on. If it goes below it, it's not like I go out and sell everything, or if it goes back above it, I'm not just jumping right in. This is a secondary indicator. Price trumps everything. So if the price is moving higher, that is what I'm paying attention to. And then I look under the hood at these breadth indicators at the sector rotation to see what is moving higher. So I don't really pay attention that much to the percentage of stocks under the 50-day and the 20-day. It's just, is the bigger trend up, and then I can go through the sector summary to see what's outperforming the market. Speaking of sector summary, actually, no, let me go back to the actual sector summary. Okay. Let me see. Okay, so let's look at 1 month. Okay. What is the strongest in the last 1 month? What out of the 9 sectors? Utilities. That's no surprise because the market's been under pressure. It's been in correction, so it's a defensive sector, has been leading. Technology finally took a back seat after one of the strongest scooter rankings there. But energy is starting. So utilities, I'm not interested in playing stocks just to play stocks. I think utilities can hold up in a correction or a bear market, but I mean, if the market's that bad, I'll just move to the sideline and focus on, navigating a list of growth stocks that are holding up. And when I get that confirmation that the market is in an uptrend, then I'll start to take my positions. So energy right here is showing me some attention, or I am paying attention to it, is starting to creep up there. Let's look at what's up in the last week. Energy, materials, cyclicals. Okay, so energy is back up here. Let's investigate a little bit. In the last 1 week, integrated oil and gas. It's some aggressive. Now these are industries. You have the bigger sector, the energy sector, and within the sector you have industries. So coal, renewables. So that's your solars, your pipelines. So all kinds of things. You want to pick the strongest industry and the strongest sector. So looking at some of these oil and gas integrated. So there's what I just clicked on all these stocks, and this shows me there is broad participation because you're seeing a lot of green, little red, but mostly green. That's broad participation. So I'm going to go over here and grab another list, and I want to kind of look at the XES for a second. There we are, all the way down there. Okay, so XES is up pretty good today, but it's still ugly. Okay, let's not kid ourselves here. This looks kind of toppy to me, but if it, and you have the 50 day, it's about to death cross the 200 day. But it's interesting to pay attention to get in potentially early. I'm not saying go out and buy it now. I guess you could if you wanted to put a stop under here. There's some accumulation coming in, but it's still not in a good technical situation. Now down here you have the XES relative to the West Texas Intermediate Crude. So what's interesting to me is you went on this nice run, this really nice run in oil stocks, and it still underperformed the actual oil. I'd like to see in an uptrend, I'd like to see the oil stocks outperform the commodity that they're trading, because the commodity doesn't have earnings. Oil stocks do. So in a healthier uptrend, you would think that the oil stocks would lead the oil. So you have a downtrend right here. It's underperforming relative to the oil, and then you have another tighter trend line right here. So I'd be interested to see a breakout right here. A definitive breakout where it's clear as day that, the oil stocks, the oil and gas stocks are now outperforming the actual commodity that they're in. It'd give me another piece of evidence more that we're getting a little bit healthier. But, right now it could just be a dead cat bounce, so we'll just really keep our eye on it. Looking at some of these ETFs, I have an emerging market ETF list, and then I ranked it by 3-month relative strength, just to kind of show you what is really, really moving. You have this Egypt ETF that is, just soaring higher, corrected a little bit, and it's looking really, really strong. So this is the VanEck Egypt ETF. There's plenty of volume right here, but this is something that you might want to look for an oversold bounce in. You also have the Vietnam ETF. VNM, plenty of volume in this one as well. See, it's just really in a nice uptrend. Yes, it sold off, but completely filled that gap, took out the high. So, you can forget this right here, because this sucker's gone with a relative strength line. So again, when you have these ETFs, if you're looking for a more conservative strategy, and you have these ETFs that are nice uptrends, nice scooter ranking, everything's going right, you look for a little oversold bounce, maybe an RSI under 5 and coming out of it. It's just an idea. I'm not telling you to go do it, but these are nice uptrending ETFs. One other one I wanted to show you. Let me go back to the industry. Actually, no, I wanted to, give me just a second. So you have a lot of, you can see that a lot of commodity ETFs are up today, but one ETF that is not a commodity that's up is this home shares construction. If we look at it on a daily chart, you can see that definitely some accumulation coming into this. This is one of the strongest ETFs of late 2017. Sold off pretty good, never really bounced, just needed some time, and is really trying to break out, is looking like it is breaking out, so with some accumulation stepping in. So even though home builders got sold off and never really bounced, something you might want to keep on your radar, because it had a nice little correction, nice little shakeout, and we'll see if this could, we'll see at the end of the week if this is a potential reversal. So just something to consider. So if you have any questions, let me know. Send me an email at steven@thetradersplan.com, and thanks for listening.